Okay folks, hello traders, welcome back. Welcome to this channel. Welcome to FX Beethoven Forex Argo Decoded. This is JD. Today we are starting on a new video series about ranges. So we will dive deep into this, and I want to make sure that you understand it. So follow along. We will release around 4 videos about this concept. So make sure you follow carefully and try to understand what I'm trying to teach you, what I'm trying to show you. Try to understand the idea behind what I'm trying to write and draw, so that you fully understand what I mean, so that we hit the purpose. The purpose is to increase our skills and our knowledge about Forex market. And I think this is why you are here. This is why you're watching this video. So remember to subscribe if you are new, and share the video. So if you are already existing subscriber, yeah, make sure you like the video, make sure you share. That's it. So now, before we talk about ranges, first of all, you have to understand what we call balance in market. Then after you understand the balance in market, then we start getting an idea how price range is formed. So there is a text below here that I want to show you. So here we have this message you have here, or information. So when the supply and the demand are unequal, the market naturally shifts to restore balance. So basically, when you have supply and demand and they are not equal, they are not on the same balance, the market naturally shifts to restore what? To restore balance. So before I move on, I will be using candlesticks to show you what I mean, because we are using candlesticks. We are not selling tomatoes. We are just using candlestick to make money. So this is assume this is a bullish candle. This is a bullish candle. Then it will have a high and a low, of course. It is a high and a low. It is a high and a low. This is a normal bullish candle. Then, sorry, let me make it bullish. Sorry, maybe I can use a different color. This is a bullish candle. Sorry, this is a bearish candle. Let me make bullish. Okay, standard colors. So this is a bullish candle. Now we have a bearish candle forming here. Bearish candle. Let's make it red. Example. Let's make it red. Now we have also a high and a low. So if you look at this candle, we can see that this candle is bigger than this one. This is buying positions. This candle represents buying condition. This buying condition. Buying positions. Now, this candle represents a selling positions. You understand? Selling positions. Selling positions. Now, so if you compare, you can see the selling positions are far bigger than buying positions. Are far bigger than buying positions. So this means there is inequality between buying and selling. There is inequality between buying and selling. These two positions are unequal. Hope you can see that. It's easy, you can see that, because this candle is longer, is bigger than this one. This means the market is not balanced. Easy to understand. This simply means the market is not equal. Market is not balanced. Market is not balanced. Market is not balanced. This is the result, because this one is bigger than this one. So in fact, we are supposed to see if we need equal market or equal price. We are supposed to see this candle around here, this bearish candle around here, on the same level, even in the wicks. Even the wicks create what? Create an equal market, an equal price, if you understand. So you're supposed to see all of these candles at the same level like this. If we see this, then we say what? We say the market is balanced. If we see this, we say market is balanced. So why do we say this? We say this because here they are telling you something. For example, if a demand for a product exceeds supply, scarcity drives the price up as a consumer compete to obtain limited goods. If you understand, if the demand of the product is very high, exceeds supplies, so there are people who are looking for something which is not there. So the available one must be very expensive. If you are looking for sneakers and there are not many, so that type of shoes must be expensive. So you have to understand. So scarcity drives price up as consumers compete to obtain limited goods. Hope you understand. This price increase often incentivizes producers to increase the supply. So if producers see that the product is wanted, there is a high demand of a product on a marketplace, so the producers will increase supply, while some consumers may reduce their demand due to higher costs. So this means if something is very expensive, you are likely not going to buy. That's the rule of the world. So you are not likely to buy. So you understand. So conversely, if supply surpasses demand, a surplus forms. If a supply surpasses demand, a surplus forms, leading to lower prices as the sellers try to attract buyers. Okay, the idea. So these fluctuations, rising and falling prices, are the market's way of responding to imbalances. You get the idea, folks? Listen to this. These fluctuations of rising and falling prices are the market ways of responding to imbalances. So this falling of price and rising of prices, for example, if this candle trades lower around here, if this candle trades lower around here, so there is a falling price action that is going on here. So as a result, market will seek ways to respond to this imbalance. Market will seek ways to respond to this imbalance. Market will seek ways to respond to this imbalance. Hope you understand. Hope you understand. So what do we mean? Market will try to solve this problem, because this is a problem. This is a problem, price action. If this candle is here and it's not equal to this one, so there is a problem. there is a problem, there is an anomaly. So market will try to find ways to solve the problem. This is why in ICT we have what we call fair value. Fair value. Fair value. Understand? So when there is something like this, there is a gap. There is a fair value gap that is formed around here that you can think mentally. Hope you can guess it in your mind, right? So there is a problem here. So this fluctuation, rising and falling prices are the market ways of responding to imbalances, constantly moving toward a new equilibrium where supply meets demand. You understand that? You understand that? Market will be looking for ways to come back at least to equilibrium to do what? Where supply and demand meet each other. So if you draw from the high to the low, 50% is around here, equilibrium level. When you have Fibonacci, equilibrium level. You have to understand that a candlestick is a range. So I'm driving you slowly so that you understand what I'm trying to teach you today, even in the coming videos. So price will try to find ways to come back here, at least on 50%. On equilibrium line, right? This equilibrium level. Market will try to find ways to come back here. Read again. These fluctuation, rising and falling prices are the market's ways of responding to imbalances. Constantly moving toward a new equilibrium where supply meets demand. So I hope you understand the idea. So market will do what? Market will find ways to come back to this area as long as it says imbalance. I'm giving you an example using a bearish. It's the same when we are using bullish condition. It's the same. So don't worry, it's the same. It's a matter of changing the colors, but the theory is still the same. If this is a bearish candle and this becomes a bullish candle, this becomes a bullish candle, the concept is still the same. It's a matter of changing colors only. So this candle is bullish. This candle is bullish. So these are selling positions. The selling positions, and we have also buying positions around here. These are buying positions. These are buying positions. So you understand that these are buying conditions. Now we have imbalance created because this candle is longer than this one. So buying positions are too heavy. So we need what? We need to seek balance. We need to seek balance. So market will find ways to do what? To come back at least on equilibrium. Sometimes not. May even not reach there because of other stuffs we may talk. But I want you to develop this sense of analysis, this way of thinking. Market will try to find ways to come back here, to seek for balance before any further move can happen. So you understand? So it may be one candle, it may be 3 candles here. It's the same. The concept is still the same. As long as buying pressure is higher than selling pressure, we want to find ways to come back. We want to find ways to come back. So this is the beginning of understanding how ranges are created. This is the beginning of understanding how ranges are created. If you focus on understanding this, you will develop anticipatory skills. You will develop anticipatory skills of what is likely to happen when you see this price action and you understand the theory, you believe it, you understand the concept. The rest is a matter of working with time frames and understanding other tricks such as manipulation or whatever we talk about. Many stuffs out there. So the beginning is here if you want to understand how to trade ranges. So this is why I say balance in the price range. Balance in the price range. So let's use the chart. Let's use the chart and see some examples. We have used sure which template I have to use because I have so many. I have so many templates. Blue and red. Okay. I will switch to monthly time frame. I mean yearly time frame. So if we start from the top around here, for better understanding, I will start from this candle. This one, this bullish candle. If you look at this candle, price traded over, up and down, but it closes as bullish candle. Assuming that you have nothing left, you have something like this. You have nothing on the left. So price traded lower. After trading lower, it traded below this low. This alone can form imbalance. Imbalance in price action because price traded lower than this one. Because if market is balanced, you are supposed to see equal candles. All candles must be equal, but it's not possible, right? So price this what? Price went down and created a pullback. There is a pullback here. That was a forming. There's a pullback here. That was a forming all the way up here. So market is trying to go back. To go back there to look for what? Look for balance. To look for balance. Then the market goes down, drops. You can see this pullback again. This can happen because of lower time frames, but let's focus on this level only. Right here. See that? Market, we have Uhuru zone as a buying zone. Buying zone around here. This is a buying because of this pullback. This pullback. Then prices start dropping all the way down. So from this level, we have buying pressure that was going on. Then we have a selling pressure that was going on, but the selling pressure is longer. Is longer. So what's wrong? So we need to find the balance. Market will not go down forever. It has to come back to look for balance. You have to look for balance because supply is higher. Supply is higher. Supply is higher, price is dropping down. Right? Then we need to go back to look for equilibrium. At least the equilibrium. Because this is buying zone. You can even start from this week up to here based on the ranges. Or you can think of this bullish candle if you are not understanding the wicks, but understand there is a buying pressure because this is a push before we drop, right? So now here, price is higher. I mean, supply is higher. So what else? What else? The game is to understand when we are changing from here to go here, when we are changing from here to go down. That's the main purpose. Now we are going up to remove imbalance. When I say imbalance, I'm not talking about this. I'm not talking about this fair value gaps we have here. No, this is not the idea. I'm trying to convey today. We talk about that if we have a time. It's not a part of this series, right? So what I'm trying to show you is to understand that the buying pressure is higher than the selling pressure. I mean, it's lower than the selling pressure, meaning selling pressure is higher than buying pressure. So there is no balance between buying and selling. Hope you understand that. There is no balance between buying and selling, because selling is higher, supply is higher. So we need to come back to look for balance, to balance the market. That's why market is trying to come back to these levels. That's why come back to these levels. It's trying to seek equilibrium, right? Now, after that, market drops again. Market drops again. Have you seen? Market drops again. After trying to create some form of imbalance, market is now dropping. After dropping, we see price traded lower. This is also imbalance. This imbalance because selling is exceeding buying. So we have imbalance. So what else? Market will find ways to go back up. To go back up. So what happens if we reach around here? Sorry, what happens if we arrive around here? Price will do what? Price will look for ways to go down again. Overall direction to go down again. But if on a higher time frames like assume like if we look left, because this chart, you know, Euro is this like this on a higher time frame. I mean on a bigger chart, it's like this. So based on the past history, we may be going higher again, because all the move we have here, it was seeking balance on the highest time frame, like a 4 years time frame, right? So that we may go higher again. But don't focus on that. Focus on the current price action, because you are, at the end of the day, you are going to deal with 4-hour candle, 1-hour candle. So you do not worry much. Focus on how it is going to come back on this level and use that to your advantage. This is how to understand ranges. This is the beginning. If you want to understand ranges, focus on understanding how balance is created in the marketplace. How balance and imbalance are created. So this is your range. This is your range. Price has traded into equilibrium. So if this shows signs of going down, we go down. Hope it's clear and understandable now. Hope it's clear and understandable. So I repeat again, whenever you see something like this, assume this is a bullish candle, then you have a bearish candle. Immediately, there is imbalance that was created. There is imbalance that was created. We are likely to see, we are supposed to see another candle going up before we go down. We're supposed to see another candle going up before we go down. Because we need to remove that imbalance. It's not you who is removing it. It's the nature of the market. It's the nature of the market. Because market, as you have seen, it's the only way it uses to create what? To remove imbalances. So it must come back. There is no other way. It must come back. It's a rule. It must come back. So we must see this forming, or we may even see another bearish candle forming after doing what? After trading higher. It tried to go back there and it got rejected. Something like that. See that? So this is the way, this is the nature of the market. So if you have something like this, understand that we are going higher. We are going higher. Price is going higher. So it's a matter of working with your time frames, 3 months, 6 months, whatever. See that? If you understand that, can you see that? It's the same in all what? In all time frames. You see these bearish candles, strong imbalance. Look, from this up move, so many candles going down. There is a problem that needs to be solved. So that's why we're going there, right? So how are we doing that? We will have demand be going higher. So this is why we have this engulfing candle creating this other block, right? Engulfing candle creating imbalance because demand is higher than supply based on candle to candle, right? From this candle to this candle, you can see that it's stronger. So we need to come back. This is why price is coming back to first of all remove this short time imbalance that was created around here. Imbalance. Then price going higher. Now, if you are a good student, if you are a student who listen, if you see something like this is setting pressure. This is a supply zone. This is supply. This is demand. If you compare which one is bigger, which one is bigger, right? See that? So what do you expect? There are two ways. Market may decide to keep moving a bit like the way they did here, but at the end in the future, assume this is bullish, at the end in the future, it will try to come back. There is no other way. It will come back. So you have to think about that. It will come back. There is no other way. No matter how long it will take, it must come back. You understand that? Now, so when I say imbalances, I'm not talking about fair value gaps. I'm talking fair value gaps are here. These are the key levels. Market is targeting that. I will not talk about that. Right in 2025 mentorship, we talk about this extensively. So price will react to that and possibly come back to do what? The purpose of coming back, it's because there is no harmony, there is no peace here because demand is exceeding supply. And the nature of the market is that we try to come back to remove those imbalances created. So when I say imbalances, I repeat again, imbalances, I mean the lack of balance. I'm not talking about the fair value gaps. I'm talking about the lack of balance. As long as one side exceeds another, there is no peace. Price will eventually come back. Price will eventually come back. And that's how you can start understanding ranges. For example, if it's here and it is coming back, equilibrium is here, right? For example, assume that price is here as of now, assume that is going to return back, your equilibrium is here, right? Because the market will always try to seek that equilibrium, right? Market try to seek that equilibrium. The problem is this: how do you know when the price is coming back? So when imbalance is created, there is something the market is hunting, right? There's something market is hunting, which is a drawn liquidity. That's all. That's the signal. Drawn liquidity. Drawn liquidity. That's why if drawn liquidity is met here, there is nothing left. There is nothing left. There is no time to look back. I mean, there is nothing to look forward. Liquidity is met, it's time to go higher. If you go up, liquidity is met, it's time to go down. Yeah. Your last area of liquidity is met. What do you expect? Pull back. Pull back. Let me show that. Let me show that. Let me show that. On a weekly, it was a perfect one. Monthly. Actually, when we talk about those who took chapter 5 on 2025 mentorship, I told you that. I told you we are going hard. There is nothing is gonna stop because we have hit our level. Internal liquidity is met. Manipulation is formed. Right here, it's time to go higher. Draw liquidity is where? Draw liquidity is here, based on monthly time frame. So they draw liquidity. Eventually, at last, this one. But the main target one is not this one. It was this one. This one. Then market keeps repeating the same when it is moving. If you switch to weekly, and try to see what happened once we get a run on this area. See that? This is a short-time liquidity. Is run. What else? A pullback to our zone. Pullback to our zone. See that? A pullback to our zone. What do you see? Signs that you are going higher. Continuation. Continuation. Entry as it forms. Entry as it forms. See that? When liquidity is made, what do you expect? It's the work. So, the whole idea of understanding how ranges and how balance and imbalance works is the building block of your trading. It's the building block of your trading because it's here. You can see it. You can see it yourself. It is what? Sellers are stronger here. So there is this buying, this selling. There is a problem. Price will try to come back. selling is stronger. Price will try to come back. Engulfing candle. See that? This candle was engulfed here. There's a problem. Market will try to come back. Drop. Market will try to come back. Market will try. See that? Market will try to come back always. You can see that. This is the fact of the market. If you understand this, your job is not about whether market is going to sit around here, around here, around here, around here. That's not your job as of now. Your job is to have these ideas in your mind. This way of thinking. That's what I'm trying to reinforce. That's what I'm trying to force you to think. So price will do what? You see that? This is selling pressure, but the demand is higher, buying pressure. So this is why do you have this red candle? Price is trying to go down. It's trying to go down. It then rejects. It goes higher. Demand is still higher, but the price will try again to come back. Look forward, balance. The price goes higher. As long as you see this, do not think in terms of structure. Just think in terms of supply and demand. Think of balance. So this market is not balanced here. So price will try to come back. That's all. That's all. So thank you guys. I think you have to subscribe to this channel if you're new. I will have to put my Telegram channel in my video description. Please check there so that you join my channel, so that you can understand my ideas. You can see what I'm trying to post, trade, I take. Yeah. And get that confidence. This series we talk about ranges. We'll not touch manipulation. We talk about ranges. And we try to make sure that you get the idea and the basic liquidity of ranges we use. And next time we'll talk about next video we'll talk about of course dealing ranges and expansion swings, so that you understand them very well and how to use them. And once you're done, I will tell you what it is we will talk about. So make sure you subscribe. Make sure you check in the video description so that you stay connected with me. So guys, hope you understand. Hope you are trying. I'm trying to make to how can I say? I want you to try to understand this. I want you to try to think how price moves, and why it moves the way it moves. This will decrease pressure on you when it comes to trading. And we also imagine price here. Assume that price here, then price here, price here, within these candles. Now price here, and you have no idea what is likely to happen. You will ask yourself, are we going higher? Are we right? No. It is just think that there is what? Imbalance was created because buying is bigger than selling. So there is a possibility of going down. So what you do, you work on what time frames, because next time we'll talk about what we call nesting price action, nesting these ideas. Right? We'll talk about that next video, right? So that you have that way of thinking, knowing when to, if for example, if you want to scalp, when you can scalp, when you cannot scalp, or when you should be you should be careful if you are day trading or if you are swing trader. When you should think of taking a partial profit. It's you who decide. It's not me who decide for you. It's you who decide based on the type of trader you are. Hope you understand. We'll talk about that. So you will define yourself for how you can approach price action. Okay. So guys, check in the video description. There is a link there to my Telegram channel so that you can do what? So that you can follow us and subscribe. I need your comment. I want to motivate me to create another video. Please give me your comment so that we keep moving, guys. Until next time, guys, good luck and good trading. This is JD, now and forever.